What if there is a single number that can tell you when the market is about to break? Not a price, not a moving average, a number from graph theory. It is called the Fiedler value, and it measures something far more important than price. It measures the structural state of the market. To understand the Fiedler value, you need to see the market differently. Imagine the market not as a chart, but as a network. Each stock is a node. Connections between nodes represent relationships, correlations, flows of capital, shared risk. From this network, we build something called a Laplacian matrix. Hidden inside that matrix are special numbers called eigenvalues. The second smallest of these eigenvalues is the Fiedler value, and it tells us one simple thing: how tightly connected the entire system is. Here is why this matters for markets specifically. A healthy market has structure. Tech stocks move with other tech stocks. Energy moves with energy. Financials move with financials. These are clusters, distinct groups of assets that behave as a unit within the group, but independently between groups. This cluster structure produces a low Fiedler value, and that low Fiedler value is the signature of a stable market. But when stress enters the system, something specific happens to the geometry. The clusters begin to merge. Tech starts correlating with energy. Energy starts correlating with bonds. Bonds start correlating with equities. Every asset starts moving together. The network becomes fully connected, and the Fiedler value rises. This is the danger signal. Rising connectivity means the market is losing its cluster structure. The diversification that existed inside the network is disappearing. Before the 2008 financial crisis, this is exactly what happened. On the surface, markets looked stable. But beneath the surface, the sector structure was dissolving. Correlations that had been moderate began collapsing toward one. Assets that had traded independently for decades began moving in lockstep. The Fiedler value climbed steadily through 2006 and 2007. By the time prices reacted in September 2008, the structural warning had been visible for 18 months. The crash did not come from nowhere. It came from a network that had lost its cluster architecture. This is the shift most investors miss. They focus on predicting price. But the real signal is structural. The Fiedler value does not tell you when a crash will happen. It tells you something more important: whether the system has the geometric diversity needed to survive stress. A resilient market has low algebraic connectivity, strong clusters, clear boundaries, modular structure. When those clusters dissolve and everything connects to everything else, the system has lost its ability to absorb shocks. You are no longer in a market. You are in a single correlated asset. And that is the moment when diversification stops working. If you want to understand markets this way, not as prices, but as systems, I have created a market geometry workbook that breaks this down step by step. You will learn how to think in networks, measure connectivity, and recognize when a market has lost its structural resilience. Download it using the link below. And if this changed how you see markets, subscribe to the channel. Because in the next video, we go even deeper into how cancer biologists use the same framework to predict when a tumor becomes treatment resistant. The biology and the markets are telling the same mathematical story. This is advanced mathematics for everyone.